You know, when a legendary value investor like Seth Klarman makes a move, people who are paying attention, well, they lean in. His firm's quarterly portfolio disclosure is one of the only times we get to peek behind the curtain and see his strategy in action. So in this explainer, we're going to break down his latest buys and decode what they tell us about his master playbook in the market right now.
But what if you could go deeper than just the headlines? To see not just what he bought, but the strategic why behind every single move? Well, that's exactly what we're about to do. We're going to decode the thinking of one of the greatest investors of our time.
Okay, first things first, let's look at the shopping list. What did Klarman's firm actually buy, sell, and most importantly, double down on last quarter?
So after all the buying and selling settled down, here's where the big money is sitting. And what jumps out immediately is that tech giant Alphabet is now his single largest holding. We're talking over 11% of the entire portfolio. That is a huge vote of confidence in a company that, let's be honest, most people already consider a titan. So here are the big chess moves on the board. He started 3 brand new positions: Fiserv in the payment space, Amcor in packaging, and a really fascinating one in Brazilian fintech called PagSeguro. Then he dramatically increased his bets on a few companies he already owned: Alphabet, the beaten-down retailer Dollar General, and the health insurer Elevance. To fund all this, he cleaned house a bit, exiting a few smaller positions to really concentrate his capital on his highest conviction ideas.
All right, so now we know what he bought. Let's get to the fun part, figuring out why. And to do that, we're going to borrow a framework from the most famous value investor on the planet, Warren Buffett. We're going to put Klarman's real-world moves to the test and see how they stack up against the ideal of a wonderful company. This one sentence right here, this is pretty much the core of modern value investing. See, for Buffett, a wonderful company isn't just about a cheap stock price. No, it's about the business itself. Does it have a durable competitive advantage? Does it have consistently high profitability, low debts, and a predictable track record? It's all about quality first. So let's put this philosophy into action. We're going to score 3 of Klarman's key holdings, Alphabet, Dollar General, and PagSeguro, against those Buffett criteria. This is where we're going to see if he's following the playbook or maybe writing a few new pages of his own. And this is where things get really, really interesting. Look at the scorecard. On one hand, you have Alphabet, an absolutely fantastic, highly profitable business with a fortress for a balance sheet. It passes the quality tests with flying colors, but it fails the valuation test. It simply is not cheap. At the other end, you have PagSeguro, which looks cheap and is profitable, but it doesn't have that long, predictable track record. And then there's Dollar General, which right now is failing on almost every key quality metric. This is not a simple story. This classic quote perfectly captures the other half of the value equation. It's not just about finding that great business. It's about having the discipline and the patience to buy it at the right price. And for investors like Klarman and Buffett, the right price always means buying with a margin of safety. For a value investor, this is where the magic happens. In that gap between a company's stock price and its true underlying worth, what we call its intrinsic value. The whole goal is to buy with a margin of safety, which basically means you're paying way less than what the business is actually worth. It's your built-in cushion. It protects you if you're wrong and gives you massive upside if you're right. Dollar General is a perfect case study. The stock has been absolutely hammered, trading around $115. But look at the potential value here. If the business can just get back on track and return to normal growth, its true worth could be closer to $168 a share. Klarman is buying well below that, giving him a huge margin of safety. He's making a bet that the market's panic is his opportunity. Okay, now with PagSeguro, the situation gets even more extreme. The market is so pessimistic about this company that the stock is trading for less than half of its estimated intrinsic value. But get this. That valuation of over $16 assumes its earnings never grow again. I mean, let that sink in. This is a classic deep value play where you are basically getting all of its future growth potential for free. So what does this all mean? We see Klarman buying high-quality businesses that aren't necessarily cheap. And at the same time, we see him buying statistically cheap businesses whose quality is, well, a question mark. This brings us right to the core of his entire philosophy. And this right here, this is the key takeaway. Seth Klarman is an incredibly flexible value investor. He is more than happy to follow that modern Buffett playbook,
buying wonderful, dominant companies like Alphabet at a fair price and just holding on for the long ride. But he's also a master of the classic, old-school approach, buying merely fair companies like PegSeguro or a recovering Dollar General, but only when they're available at a truly wonderful bargain basement price. He's showing us there are two different paths to a great investment.
So looking at these two paths, it leaves us with a final question to think about for yourself. In your own approach, what do you prioritize? Are you a hunter for wonderful businesses, willing to wait patiently for a fair price? Or are you a hunter for wonderful prices, willing to compromise a bit on business quality to get that deep discount? Klarman's playbook proves there's more than one way to win.